The world's most valuable company, Nvidia, gave another bullish quarterly revenue forecast, suggesting that the rapid growth of AI infrastructure remains on course. Now, the outlook soothes concerns about a bubble in AI investments. Now, for its fiscal fourth quarter, it beat on both the top and bottom lines, driven mainly by the massive 75% revenue growth in its core data center business. Now, the stock initially rose over 3% in extended trade. Now it's up about 0.8%. And Wall Street has been betting on the robust demand for Nvidia's AI chips, but there are also signs that the firm's long-held market dominance could be under threat. Now, after powering much of the market higher for, in fact, much of the past few years, Nvidia shares have gone cold in recent months as investors question whether the hundreds of billions of dollars that big tech is pouring into data center infrastructure are paying off. Also, Nvidia is still waiting for clarity on whether it's going to be able to do business in China, the largest market for its products. The chip maker's latest results come at a critical time for the U.S. stock market, with investors increasingly nervous about the AI outlook. Well, Wall Street rose ahead of the earnings release. It was building on the previous day's tech-led rally. Stocks touched two-week highs as concerns over AI disruption and costs took a backseat to renewed optimism over the tech's potential benefits. We're joined by Jason Ware, Chief Investment Officer and Head of Research at Albion Financial Group. Jason, thanks for your time today. Just want to look at Nvidia's results, of course. So expectations were very high going to the results. You've also questioned whether they will be great enough. And so based on what we're seeing, the latest figures and the forecast great enough in your books?
Yeah, it's good to be with you. So the line was the results are going to be great, but will they be great enough to move the stock? And what we're seeing after hours is investors aren't quite so sure. The numbers were good, no doubt about it. Up 73% in terms of total revenue growth. Data center was up 75%. Gaming, visualization, all the numbers looked really good. And we're talking about a run rate for this company that is north of 300 billion. But the challenge with Nvidia is that it's cheap on a PE basis, but it's expensive if you look at the market cap. I mean, we're getting close to 5 trillion. The US economy is 30 trillion. So how big can this thing be over the near term? And that's kind of the tension right now in the market.
Yeah, and Nvidia's results come as we see it basically carrying the tech sector, while trillion-dollar names like Microsoft, your Amazon as well, they've retreated despite the massive AI spending. But you're still constructive on U.S. tech overall. Where do you see the most durable structural advantages? I also know that you mentioned the Splendid Six.
Yeah, so everyone's talking about Mag 7, and for 6 months now or so, we've coined our approach, the Splendid Six. It's basically the Mag 7 minus Tesla. Tesla's been too expensive for us for a long time. It's trading at 200 times earnings. So a lot of good news priced into that stock. Instead, we like to go where it's growth at a reasonable price, and that's going to be your Microsofts, your Nvidias, again, trading at 24 times forward earnings. Google was less expensive. It's now a little more expensive, but still not bad at 28 times earnings. Meta's at 22 times. Amazon's trading at the cheapest valuation since we've owned it, and we've owned it for over a decade. So we think the Splendid Six is still somewhere you can go to get relative value with good quality companies in tech. And these are the companies driving the bus around AI growth. And they all have very different business models. So you can diversify within the Splendid Six. We also like Avago as well, which is Broadcom.
Yeah, I just want to build on, the broadening out of the AI trade. Nvidia's data center revenue rose to, over $62 billion. The CFO of the company says they've got an extra $11 billion of data center revenue from a more diverse set of customers. I mean, does this alleviate some of the concern you think that people might have about how growth is just concentrated in a handful of hyperscalers?
I mean, it still is concentrated in a handful of hyperscalers. There's no question. Is it broadening out a little bit? Maybe. We're seeing Amazon spending 200 billion in capex alone this year. Google's going to be 185. Microsoft will be 160. Meta's going to be 150 plus. So it's still the biggest hyperscalers without question. Oracle's a big buyer. So definitely, half a dozen companies that are their largest customers. That might move around a bit quarter to quarter, but at the end of the day, you can't get away from the fact that it is a highly concentrated customer base, but it's a customer base that has a lot of money, great operating cash flow, strong balance sheets. These are the best businesses in the world, and they can afford these chips. So while the concentration is among a half a dozen companies, these companies don't have us concerned at all about their ability to finance GPUs.
And Jason, you said that the bearishness around the USD is overdone, and where it's at now is consistent with U.S. macro fundamentals. You also say that U.S. tech valuations are mostly attractive. Does this account for a higher for longer USD situation? And if the dollar stays around, these levels, then will we see a cap possibly on how much further the splendid six can run?
I don't think so. The tech trade is going to live or die based on the fundamentals. It's not going to be a dollar story. I understand why you're asking the question, just given the percentage of sales overseas is higher in technology than other sectors. But again, at the end of the day, it's going to be AI spend. It's going to be ROI on AI at the enterprise level. It's going to be consumer adoption. It's going to be whether these companies are managing the AI transition in a way that is consistent with how they've been for the last 10 years, which is keeping the balance sheet healthy. Those things are going to matter. Overall demand. These things are going to matter a lot more than the dollar. I will comment, though, as I said, I think the dollar is in an okay position. People are pretty bearish on the dollar because it's come off of its high about a year ago. But I see that more as normalization. If you zoom out a little bit and look at the dollar chart over, the last 2-3 decades, we're in a zone here. Let's call it 90 to 100, 95 to 105. That is pretty consistent with an economy that is behaving the way it is here in the U.S. relative to global GDP and other economies around the world. So we're not dollar bears.
All right, Jason, I appreciate your time today. Jason Ware, Chief Investment Officer and Head of Research at Albion Financial Group. And Sarah Al-Khaldi is here to tell us more. So, Sarah, what does Nvidia's earnings tell us about, this AI boom?
Yeah, it looks like it's still going strong because Nvidia says for this quarter, it's expecting sales of $78 billion, and that is more than what the market was expecting. It beat on the top and bottom lines. When it comes to revenue, in fact, that jumped 73% on year in the fourth quarter. Net income, that almost doubled from a year ago. And this really shows that the AI race is continuing. We are seeing continued expansion in infrastructure as well as spending on the back of fears of an AI bubble. But we also have to keep in mind that there are risks and challenges to Nvidia's dominance in the AI chip space because the likes of AMD and Google, they're also making headway in their own chips. Now, when it comes to China, of course, that was something that we were looking at closely with Nvidia's earnings. The company said that they're not assuming any sales for their data center chips to China for this first quarter forecast. They did receive licenses from the U.S. government to ship small amounts of the H200 chips to China, but we still have to see if that gains any ground.
Yeah, but still, that's boosting AI plays in Asia as well.
Absolutely. So we did see this AI play for the past few years really boost the supply chain here in Asia, in particular South Korea, because just yesterday, South Korea's benchmark equity index crossed 6,000 a month after crossing 5,000 when it was once unimaginable. So now we are seeing South Korea's stock market worth more than Germany as well as France, even though South Korea's economy is a lot smaller than the other countries. Now, those gains that we saw in the Kospi, which is up more than 4% in the first 2 months of this year, that has been powered by South Korea's memory chip makers. In fact, that Samsung and SK Hynix that have been really dominating the AI memory chip space. Samsung, it's up nearly 60% just in the past 2 months, year to date. SK Hynix up more than 50%. So why is it so important? Well, Nvidia is really the brains behind AI, and these memory chip makers, they provide memory that help the brain think fast. And so they are so important, they are so in demand that SK Hynix is actually sold out for the rest of the year, and it's only February. So the question now is whether the Kospi can move even higher. And Nomura has come out to say that they see the Kospi hitting 8,000 in the first half of this year, and they are the first brokerage to project it at this level. Now, they think that will be supported by the memory supercycle, AI earnings, and the corporate value reform program that we are seeing in South Korea.
Yeah, I mean, Kospi, 6,000 yesterday. About a month ago, it hit that 5,000 milestone. So if we're looking at this rate, Nomura's bet on that 8,000 mark really doesn't seem impossible at all. I mean, if AI momentum continues. Of course, Sarah, thanks for breaking this down for us. Sarah, of course, breaking down Nvidia's latest earnings report and really what it signals about the AI boom.